Look closely at market expectations right now. Now, the entire crowd is looking backwards. Right now, the market is pricing in 39 basis points worth of Federal Reserve rate hikes. Now, keep in mind this number because it's going to be very important in the analysis ahead for the dollar. Let's keep it simple. A regular Federal Reserve hike is about 25 basis point hike. So even after a weak NFP report, lower oil prices, even after all that, the market is still pricing in almost two rate hikes from the Federal Reserve. One full basis point hike plus a 50% chance of another hike before the end of the year. Why is that? I think the market is way off on that. And this is where the opportunity begins, because next week, that narrative is most likely going to break. But let's go step by step here. Here's the facts. Now, we got a new Federal Reserve Chair, Kevin Walsh. He came in swinging on his first FOMC. They left rates alone, but they stripped the easing bias out of the statement. And the dot plot, most importantly, which is a fancy term, for a simple chart where the Federal Reserve just guesses where interest rates are going to be ahead. Now, in that dot plot, 9 FOMC participants penciled in a rate hike this year. So 9 FOMC participants saw a potential rate hike this year, and this was in June 17. Okay. After this, obviously, what the market did, they went on to price in 25 basis point hikes fully, completely. Okay, we're looking at interest rate expectations for the Federal Reserve right here. As I said, right now we're pricing 39 basis point worth of hikes. After the FOMC, this rocketed higher to pretty much 50 basis points worth of hikes. 2 rate hikes fully. I faded back a little, but we're still pricing way too much. And this is what it gets really interesting, because the setup starts here. The market priced in those hikes because of one thing: higher energy prices. Now, that's obviously a big source of headline inflation. Oil prices are strongly correlated with headline inflation. Right here, we're looking at headline inflation in the orange line and oil prices in candlesticks. You can see the correlation. Headline inflation is dictated a lot by energy prices. That's a known fact, and it's why also the Federal Reserve tends to look more at core inflation rather than headline inflation, because of this. Because energy prices tend to spike and deliver these temporary moves on inflation. You know where I'm going with this, because this energy price spike already reversed. Now, oil prices is already trading almost below the pre-Iran situation. So the market is pricing Federal Reserve hikes off of a number, off of a context, a situation that is already stale. They're looking backwards at an energy crisis that is already fading. Okay, the market is still pricing itself on headline inflation being at 4.2%, while in fact, soon this headline inflation will be back to acceptable levels. And whenever the market is looking backwards, that gives us as traders an opportunity, because the hike premium that is priced right now is priced off a risk that is already gone. So let's look at all of this from the Federal Reserve perspective, because the Federal Reserve does not just hike rates for fun. They need a reason to do so. They need proof. The biggest pieces of proof that are part of the Federal Reserve mandate are the labor market and inflation. To hike, they need most of the time 2 things: a hard labor market, or at least a solid, decent, stable labor market that can withhold interest rate hikes, and they need higher expected inflation. They don't just react backwards. They need to know that inflation ahead is going to stay high and it's probably going to be higher. They're not going to hike just because inflation spiked temporarily to 4% and next month it's going to be 3% or whatever. They're not going to overreact to that. So let's go step by step here. Do they have a labor market that is fairly stable right here? Well, let's check. Not quite, because the latest NFP missed expectations and the previous 2 months were revised lower. Now, in total, NFP for April was revised down by 31,000. The NFP for May was revised down by 43,000. Now, a 74,000 net revisions lower on the previous NFP. So this number is wrong, it's lower. And the actual NFP latest printed fairly low compared to forecast. Okay, we can clearly say here that obviously the labor market is not collapsing, don't get me wrong on that, but it's also not giving the Federal Reserve the right excuse to justify a hike. So if the labor market is not demanding a hike, is not making the case for the hike, Well, the entire base case for those 39 basis points worth of hikes for the year, well, they rest on just one thing: inflation. Which brings us to the most important moment that decides how the dollar will move next, the next big swing. Because on Tuesday, July 14, the next CPI inflation report will be published. This is the missing piece of the puzzle because it's the first report that should actually show those energy prices fading. Now, the most recent headline inflation print, as we've seen, has been 4.2%. It was hot, obviously, unquestionably hot. Core CPI also fairly hot. And those hot prints is why the market thinks that it can justify a rate hike from the Federal Reserve. But again, let's look under the hood. We don't have to look backwards. How is the context developed ahead? So how is the next CPI most likely going to print? Well, why the latest CPI was hot? Why core CPI printed, why headline CPI printed at 4.2%? Well, because of the spike in energy prices. That spike has faded pretty quickly. So what's the most likely scenario for headline CPI? Well, to some extent, is most likely going to fade to at least 3.6%, most likely even lower in the coming months. So next week, it's already consensus essentially that headline inflation will come down to 3.8%. So it's already expected to cool down. Core CPI as well expected to cool down just by a tick. This in and of itself alone is already enough. If it comes in line as expected, it's already enough to start to erode that scenario where the Federal Reserve potentially could need to hike. So if headline inflation falls and core inflation comes in line, or even better, and this is the scenario that I actually think is most likely going to happen, headline will most likely print even below expectations here, because we've seen the correlation. Well, correlation would suggest that headline inflation could come most likely 3.7%, potentially 3.6%. Now, I'm talking, obviously, we can't exactly say for certain, but we're building the probabilities here. We're building the scenarios here. So let's say that, as I think will happen, inflation will be slightly softer than expected, or at least, to the very least, in line with expectations. Well, the case for the Federal Reserve hike is going to be much lower. And the two sides of the Fed mandates will line up against the hike, because we're going to have a softening labor market to some extent, not collapsing, but softening to some extent labor market. And then we're going to have inflation, which is already fading back towards the Federal Reserve target. Obviously, the Fed's target is a long way, 2%, but it will remove that risk that inflation is again running out for control, okay, and needs the Federal Reserve to act. So at that point, the scenario ahead will start to become a little obvious. The market should not be pricing in 39 basis points worth of hikes. Well, and then when it becomes obvious, that repricing will become extremely obvious. It will become extremely fast and obvious. So listen to me closely here, because this is the most important part of the narrative. I'm not saying the Federal Reserve is going to cut rates. No. I'm not saying the Federal Reserve is going to panic and do whatever. No. I'm not saying the US economy is falling apart. I'm not saying inflation will come down to the Federal Reserve target in a couple of months. I'm not saying that. We don't need any of that to trade for this trade to work out. We only need the market to admit that 2 rate hikes, meaning one full rate hike and a 50% chance of another rate hike, is too aggressive. So if those 39 basis point worth of rate hikes that are priced in before the year end, if they start to come down, well, the dollar starts to come down with it, because the correlation is undoubtful, okay? So next week with the CPI is where the market is going to find out. If those 39 basis points start to fall back to a more acceptable neutral range of maybe half a rate hike, so 15 basis points, that's a fairly reasonable range for the expectation for the Federal Reserve ahead. Now, could they hike? Yes. But are they going to hike? Well, no. Probably most likely not. So a full rate hike plus 50% chance of another rate hike is just a lot. Okay? It's going to need to price down a little bit if inflation next week prints either in line or soft. Now, the contrary is also true, and we have different outcomes here, but this is where we assign probabilities, okay? So we have different CPI scenarios. The soft CPI, Obviously, rate hikes expectations are going to fade. That's bearish for the dollar. The inline CPI, we've seen inflation is already expected to come down. So an inline print is already decent. Rate hikes expectations are going to fade slightly, which is slightly bearish for the dollar. Now, the risk, obviously, there's no trade without risk. It can become hot. Inflation might print hotter than expected, while in that case, rate hike expectations are going to increase, and that's bullish USD. This is the whole point, and this is fundamental analysis. It's analyzing the context. It's analyzing how things are most likely going to unfold and assigning probabilities, because based on how energy prices, which have been a big source of inflation over the past couple of months, have moved, well, we can say that the most likely scenario is either a soft CPI or at least, to the very least, an inline CPI. So we could say maybe the hard CPI is a 20% chance and the inline CPI is 40% chance and the soft is 40% chance, which gives us a cumulative scenario probabilities of an inline and soft CPI of about 80%. Okay? This is the risk reward that we're building, the scenario probabilities that we're building for the event. Hard CPI, it's possible, but it's fighting against an inline and a soft CPI. It's 80% probability against 20% probability. Okay? Short term, it does not have to be more complicated than it is. Next week's CPI is where the market will find out. It will need to price out the rate hikes that are expected for the Federal Reserve, or maybe not. If that 20% probability unfolds for a hot CPI, well, it's not going to happen. But, probabilities tend to favor the soft or inline CPI. Okay, that's all. If you like this type of videos, these live deep dives into market dynamics, let me know with a like on the video down below.